Oil futures just hit 4-year lows, down 20% since the latest tariff announcements. With rising inventories and OPEC boosting output, is this a warning shot for the broader economy? We'll explore why oil is signaling turbulence ahead, how it's becoming more correlated with markets, and what investors should watch next. At the end, you'll know what falling crude might be trying to tell us.
Gary, we're going to move right to thing number 5. We got an extra thing on this week's version of the 5 things, but we're talking about oil prices. It seems they're responding to greater fears of economic turnover or turmoil, higher inventories. We're really looking to understand, okay, what does the oil market look like moving forward? Gary, thing number 5, oil futures on edge. What's next for that market?
So, Rob, we talked about this a little bit in a recent edition of the 5 Things. I think it was last week we were talking about Brent crude pricing. This week we're talking about WTI. That stands for West Texas Intermediate. To give people, just sort of your shorthand for it, think about Brent as the international price, WTI, West Texas Intermediate, as the U.S. price. Now, if people want to point out that's not exactly perfectly true, it's close enough to give you a sense of what's going on. And yeah, those prices tend to track each other. And so last week we were talking about Brent crude prices, I think around 64. When we did the chart on West Texas Intermediate, it was just above 60. I think it was a 61, 62, something like that. So they tend to be pretty close. And what we've seen is prices have come down since the tariff announcements on 2 things. One is fears of a future worldwide recession. And when the world has economic problems, energy usage slips. And because oil is priced at the margin, meaning the last barrel of oil is really what sets the price, small increases or small decreases in oil demand tend to have a huge impact on price. And the other thing that's happening is OPEC producers are raising output, which is putting the U.S. into a surplus, and we're seeing inventories go up. And so all of those things are working together to get oil prices down. Now, that may not be great for the market, but it's not so bad for U.S. consumers. As a reminder to people, oil is a huge part of the costs that go into almost everything that we have. And, for people who say, well, no, I bought something that doesn't have oil in it. Yeah, but there's energy required to produce whatever it is you just bought and to have it shipped and trucked to the factory, to the store, to your house. Energy usage is just a huge part of the cost of things. And so that is one of the reasons why the CPI, which we were talking about earlier in this episode, was lower. Energy prices were down a lot.
Gary, so there's a big market dislocation here. How does that get corrected?
Well, so Rob, there's an old expression, and I'm not the one who came up with it, is that, and it's going to sound like a tautology, but the cure for high oil prices is high oil prices. The cure for low oil prices is low prices. And here's what that means. Let's imagine for a minute that we're short on oil supply, inventories are low. That will send oil prices up. As that happens, marginal producers who have closed down wells or might be producing at low levels say, well, wait a minute, at this higher price, there's enough profit here that I will reopen wells. I'll start pumping. Or, if they're pumping a well at a slow rate, they may produce more from that. They do have a certain amount of control over that. And doing that will bring more supply into the market and reduce pricing pressure, lower prices. Well, it's the same thing in the other direction, right? Generally, sort of the rule of thumb is the shale oil and fracking in the U.S., that break even, that number where producers will start or stop producing is right around $60 oil, which is right around where we are now. So if oil drops much further, then we're going to see the marginal U.S. producer say, you know what, we're going to slow down production. And what that will do is that will reduce supply. It will reduce the excess in inventory, and you end up with higher oil prices. So basically, there's not a whole lot that has to happen. The market actually fixes it by itself. You just need to be a little bit patient.
Great stuff, Gary. For the last thing, the sixth thing, bonus thing this week, we're going to move into educational topics. Before we do that, be sure to head over to deepknowledgeinvesting.com. Again, you can sign up for a free subscription, get added to our mailing list, or we have premium subscription at $100 a month. That's going to get you access to all premium gated content, current recommendations, when Gary's buying, when Gary is selling, as well as many other features for premium subscribers.